So a stock market, equity market, or share market is really an aggregation of buyers and sellers of stocks, which are called shares. And this represents ownership of the businesses that are being traded publicly. Now, investment in the stock market is mostly done through online brokerages and electronic trading platforms like Questrade, TD Ameritrade, Schwab, and so on. And investments are usually made with a strategy in mind. And this is what's written within Wikipedia. Now let's talk about the type of people or entities within the stock market. Now the first one is really mutual funds. And this is really a team of people picking stocks, usually have a very diversified portfolio. Generally, mutual funds have access to all the paid information that is more than a retail investor, such as using Bloomberg Terminal, which can cost tens of thousands of dollars, paid subscriptions. When it comes to mutual funds, you can really just buy them at your local bank. Just walk in, talk to your financial advisor, and they'll have the full list of mutual funds that they could just buy for you. The second one is really pension funds. This is usually when your corporation partners with a pension fund to basically plan for your retirement for you. And again, it's a team of people choosing different mutual funds or hedge funds to invest in. They focus on having a very diversified portfolio, and their time horizon is usually longer because you can choose when you want to retire. For example, you want to retire in 2050, 2040, or whatnot. And many governments focuses on managing and having such a pension fund for their employees. And usually, if you are working in a government entity, then the pension fund deal will be pretty good. In the past, they used to have kind of what they call a defined benefit plan where they promises you a certain amount every single year when you retire. But I think nowadays they're transitioning the plan to a more contribution focused plan where if you put in $1, the government will also put in $1, but then there's no guarantee on exactly what is the amount you'll get when you retire. When you're looking at mutual funds and pension funds, I would say most of these are long-term focused. And I would say pension fund is actually more long-term than mutual funds, but nevertheless, they focus on doing research, choosing investments, and holding it. Now, the third group of people is really hedge funds. This is a free-for-all playing field where you can use the riskiest strategy, you can hedge, you can use leverage, and you have hedge funds that are using supercomputers, and they pay for the latest and greatest investing strategies. Like they would pay for a lot of data just to analyze how Starbucks is expanding across US and China. They would hire PhDs in mathematics and engineering to do whatever analysis they need to basically listen to the noise within the market to have that edge to trade within a second like 100 times. So most of the time you can't really invest in hedge funds because you need at least $1 million in terms of net worth. The minimum investment when it comes to hedge fund based on my experience is 200, 300,000 or more. In terms of these kind of strategies, it is usually out of reach for most investors. Now, the fourth group of people is really retail investors. So that is you and me. And there are two types of retail investors based on my experience. The first one is long-term. That is myself, where we are conservative investors that focus on long-term growth. And usually if you're using a normal strategy, then you will get somewhere between 8 to 10%. Hopefully you're beating the market. Some of the better long-term investors can get between 10% to 15% for a couple of years. But if you don't do anything crazy, then probably you can retire by 65 with $1 million in your portfolio. Now, the second group of people are short-term traders. And these traders focuses on either boom or bust. They focus on getting rich quick. And this usually have a more unrealistic expectation when it comes to what kind of return can be made within a year. Let's say 100%, 200%, something crazy like that. This is where you need to commit a lot of time watching the markets, being glued in front of the computer screen so then you can make a higher return because you're watching every tick of the market. And this is usually where most of the scammers, when it comes to investing, place their trap because they will promise a very high return, but when in fact it cannot be easily achieved. So then a lot of people fail when it comes to short-term investing. And this is really where you get the saying of 95% of day traders or short-term traders fail. So that concludes this episode, and I just want to celebrate 3 case studies within Investing Accelerator where Mike sold his last 1/3 of Alta for 118% profit in 4 weeks. He also sold Citigroup for a 39% profit in approximately 1.5 to 5 months, depending on which position you're looking at. He also sold half of Baba for 47% profit in 6 weeks. And the third case study is where Flo sold AXHR for 149% profit in 10 months. So that is actually the longest she has ever held for an option, which is becoming more patient, and that is fantastic as well. So it's another 100% return. So for Investing Accelerator, this month I'm looking to help 20 people to master investing. So if you want to learn more, then you can go to the first link below. And I'll see you in the next episode.